Welcome to Courses for a Cause, another installment of EPM's educational series. Today, we're going to be talking about the 2023 interest rate environment, provide an update to the forecast, and also provide an update on the housing market as well. As always with these educational events, we always tie them to a charitable cause. Today's cause is David's Dream and Believe Cancer Foundation, a local nonprofit that donates funds directly back to families battling a cancer diagnosis to help them with the expenses that come along with their battle. If you feel so inclined, feel free to text Equity EDU to 91999. The donation would go directly to the foundation. There's no obligation, but please feel free to support them if you're so inclined. If you have any other interest in additional courses, for those of you who have participated with us in the past, we do offer a myriad of educational classes, including CE courses for real estate agents, financial planners, attorneys, accountants. Some of our most popular courses are Mortgage Finance 101, Renovation Financing 101, and Reverse Mortgage 101. And we're constantly adding courses to the catalog as well, and adding multiple states where we provide these courses. So if you have any interest in these, please reach out to your contacts at EPM, request additional information, and we're always open to feedback as well on and suggestions for new topics and courses that you guys want to learn about and be educated on. So today we are honored, and I am proud to introduce my longtime friend and my partner, Stephen Carpitella. He is the Chief Retail Officer for EPM. He's a certified mortgage advisor, a graduate of Rider University with a degree in accounting and finance. Prior to joining the mortgage industry over 21 years ago, he was a former public accountant. So he brings a knowledge of numbers and economics to the role at EPM. Personally, he has been responsible for over $2 billion in mortgage volume and personal loan production over his career, and he's consistently ranked in the top 1% of originators nationwide. So we're really honored to have him at the helm. He's going to walk us through the topics today, and I'm real excited to hand it off to my friend, Steve Carpitella.
All right, thank you, Chris, and welcome everybody who's on here today. I'm going to, so this presentation that we're giving today is really to, set the record straight. There's a lot of misinformation in the market, and want to, this is actually a presentation that was presented to us by Barry Habib, who is, a mortgage guru. He's three-time Crystal Ball Award winner, for his predictions that he's made. And he just recently gave this presentation at the MBA conference in Atlantic City a couple of weeks ago, and was kind enough to share that with us. And, so there's a pretty compelling story to be told about what's going on in the market. And the objective of today's call is to bring everybody up to speed on what is really going on. And this information is supported by empirical data. So not so much speculation as much as, real data that's out there. So a couple of the topics we're going to talk about today: inflation. It's been all over the news. What is it, and what is its relationship and effect on interest rates? The job market and economic outlook. What's going on, what's really going on in jobs, and what's really going on in the economy. And ultimately, we're all in the real estate business here. How does that have an impact on the housing market outlook? So kicking things off, inflation and the relationship to interest rates. A lot of people, I don't know if they really know the technical meaning and what inflation is. So again, today is to set the record straight on what it is and what it isn't. Inflation is a rise in the price of goods and services over time. As the supply of goods decrease, demand increases and prices rise. We see that in home prices, over the last couple of years, right? More buyers than sellers. And when prices rise, each dollar buys fewer goods and services. So, in its actual definition, inflation is too many dollars chasing too few goods. That's what drives the price of things higher. What a lot of people don't realize, is how it's measured. It's the consumer price index. a measure of the average change over time in the prices paid for goods and services. So what somebody was paying for a carton of eggs a year ago versus what they're paying for a carton of eggs today, as an example. How did we get here? How did inflation, come to be? There's something called quantitative easing, or QE. If any of you watch financial news and want to know what quantitative easing is, it's the Federal Reserve literally turning on the printing press, like printing new U.S. dollars and going out and buying, mortgage-backed securities and treasury bonds. So they're creating a fictitious demand for these assets. And again, when there's a demand for something, you drive the price higher. So again, what a lot of people don't realize is you drive bond prices higher by buying more bonds, the corresponding interest rates tied to those bonds go lower. And that's how they were able to push mortgage rates lower during the pandemic. The stimulus, the Fed also printed money and handed out lots of dollars. So not only were they printing all these dollars and just buying mortgage-backed securities and treasuries with them, they were also handing these dollars out to consumers. Increased demand, the supply chain grinded to a halt during, as a result of, COVID, and that resulting in very few goods chasing increasing prices. So again, we ended up with lots of dollars chasing too few goods, and literally the definition of inflation. So what now that everybody has a basic idea of what inflation looks like, what it is, too many dollars chasing too few goods. Again, you're not going to become an economic expert in this on this call, but just understanding very low level, inflation drives mortgage rates. There is a corresponding relationship between mortgage rates and inflation. So, this is a chart just looking back from 2018, but we can go back as far as we want to go here. And you always see that mortgage rates, the higher line here, the blue line, is always higher than inflation. And the main reason for that is, you need to charge more money than the cost of money, or you're losing money. So there's a direct relationship here. We'll get into this chart a little bit more. We'll get into this chart a little bit more here, but like as we got into COVID, here's COVID with the shaded area here. January, was the beginning of 2020, right around that March timeframe. This is when the Fed turned on QE. Okay, quantitative easing. This is when the Fed started handing out stimulus checks and started buying a bunch of bonds. What they did, inflation was dropping during this time, right? Recession, people were spending less money during that time. So you had a drop in inflation, and you could see interest rates closely follow this as they were drifting lower. And then the Fed is printing bonds to keep mortgage rates lower. Well, why they were doing that, you could see this QE period here all the way through the beginning of, basically beginning of 2022, inflation started taking off. Inflation started spiking. There's too many dollars on the street chasing too few goods. And this is arguably when the Fed should have stopped QE, right? Inflation started going up. They should have turned off the printing press and allowed mortgage rates to stay above inflation. But what happened was they kept mortgage rates low for an extended period of time after inflation had already taken off, above the Fed's mandate of roughly 2 to 3%. This is typically where they're trying to keep inflation. And you can see it took off well above that, skyrocketing all the way up into the 7% range. And mortgage rates lagged behind this for the simple fact that the Fed was still buying bonds. They were keeping mortgage rates low when they should have kind of let that go. Eventually, they ended up turning off QE. And as soon as they turned off the printing press, you can literally see mortgage rates are now flying higher all through 2022 to catch up to inflation, ultimately getting back up above inflation where mortgage rates belong. So the goal of sharing this slide is to show you the relationship between mortgage rates and inflation. So mortgage rates follow inflation, always have, always will. So higher inflation caused higher interest rates. To understand inflation, we got to look back on the past. Okay, so this is the CPI numbers over a 12-month period, and you can see here this is 2021 we're looking back on, and then we get into 2022, and now we're into 2023. So every month that goes on, this March number here replaces the previous March number. This April number here replaces the April number of the prior year, and so on and so forth. So as we get into this year, right, we see these numbers here, this March number is replacing this March number. 2022, inflation was very high year over year going into April, May, and June. The likelihood that these numbers are going to come in lower in the coming months, the April, June, and July reads, is high, very likely. And this is why you'll see mortgage rates start to coming down, because inflation is coming down year over year. So this is, one of the drivers behind why we think interest rates are going to go down is inflation is on its way down. And the way we prove this is shelter cost. 43% of the core CPI number is rents. And as you can see here, rent took off in 2021, almost to the tune of up over 18% year over year. The CPI number, lags behind this. Okay, so, there's a 15-month lag between shelter cost and core CPI. Year over year rents were going up 18% year over year, while inflation was still relatively low. So this comes down to, the difference between the two. You got 5.6%, which is the current core CPI number. If we were to measure rent in real time rents are closer to 3%, as indicated here. So with 3%, this being at real time 3%, inflation isn't at 8.1%. If we strip out the shelter cost only being up 3%, core CPI would be 3.2 versus 5.6, which is more in line with the Fed's mandate of maintaining inflation in a 2 to 3% range. So we should argue the Fed should stop stop hiking interest rates immediately, but they're not. They're still continuing to increase rates. And this is, famous Wayne Gretzky saying, a good player skates to where the puck is, a great player skates to where the puck is going to be. And the Fed skates to where the puck was. They're looking back on data as opposed to looking forward on data. And that is one of the issues and why we're seeing the Fed still continue to hike rates, because they're looking at data that is from the past. So Janet Yellen, was saying, go big, inflation's too low. During this period of time, inflation was always all the way down here, and they continued to have that QE machine running. And, but at that time, only 2.5% reported it in the CPI number, because they weren't factoring in real-time inflation. Again, rents year over year were spiking through the roof, literally up almost 18% year over year. So this lag in shelter cost is eventually going to catch up. Shelter costs have come down. So you're going to eventually see this core number start to come down. And again, there's about a 15th month lag, and we're at that 15th month lag. And we're starting to see that in the last CPI reading that inflation is coming down. So if inflation's coming down, and that there's a direct relationship between inflation and mortgage rates, what do you think the next direction for mortgage rates is? Lower. That's right. So it's this is the number, this issue where there's a lag in year over year rent, because these surveys aren't done till 4 or 5 months after someone signed a lease. So by the time it catches up in the data, like this is showing, inflation's still on the rise, when we know 43% of that inflation number was year over year rent. So that's a big portion. Almost half that number is rent cost. So as this number comes down, inflation's coming down. If inflation's coming down, interest rates are coming down. So getting the Fed was data dependent. Again, they're looking at where the puck was, not looking at where the puck's going. And again, this is where there's a disconnect, this real-time rent up 15%, while they're saying, hey, we need inflation. It was already happening. And again, a reason why they should have turned off the printing press right here. As soon as inflation started spiking, this is when they should have turned off QE. They kept rates lower for a longer period of time. So think about what that did to the economy. We already have too many dollars chasing too few goods, right? And now you're keeping rates even lower. That's just fanning the flames of inflation, right? We're not deterring the consumer from spending money. We're encouraging it at a time when inflation's already running out of control. So, look at this period of time here. You're talking about, roughly May, June of 21, and they ran QE all the way through to the beginning of 2022. So like, it doesn't make any sense, right? You know, they should have turned this off a long time ago. So this is why we're seeing, 2022 mortgage rates jump, 6 points, 5, 6 points in 9 months. Why did that happen? Because of that, almost the rubber band snapping back effect. The Fed kept the printing press going for too long. So again, that's the story on inflation. And why the Fed's still hiking the Fed's fund rate. You guys are going to know 99%, more than 99% of the world right now when I tell you this. The Fed's fund rate does not control mortgage rates. It controls all debt other than mortgage rates. And the only way that the Fed can control mortgage rates is to simply turn on the printing press and actually buy bonds, but they're not doing that. So the Fed hiking interest rates is to fight inflation and curb consumer behavior. And that's what's going on right now. So, this is the story of inflation. The takeaway from this for everybody is to know for fact that mortgage rates follow inflation. Always have, always will. There's a direct relationship there. Before I jump into the next topic here, which is the economic outlook, anyone have any questions on this? I know this is a lot of information to take in a short period of time. But again, the takeaway is just understanding inflation is too many dollars chasing too few goods, and the fact that mortgage rates are directly tied to inflation. If no questions, I will move on. Chris, you can keep an eye on the chat if you see anybody throw any questions in there. So, what does this mean for the economic outlook? The goal of this next presentation of slides is to paint the picture behind what's really going on in the job market, what's really going on in the economy. So, the beginning of the year, right before the State of the Union, as you would have it, if you want to imply some timing around that, the unemployment ticking down, not going up to a 50-year low. And we had this blowout jobs report in the beginning of the year, if anybody remembers. Well, the reason that happened is they seasonally adjusted month over month and the change in thousands of jobs. So essentially, if you don't adjust seasonally, jobs are actually going down, not up. But this is a great picture to present if you're giving the State of the Union of the country about how healthy the jobs market is. Well, they seasonally adjusted the 2023 population control effect. Not sure what that is. Nobody really is, but added 800,000 jobs to the jobs picture. So obviously this is going to have a major impact on what it looks like is going on actually in employment. If any of you are watching the news, you see companies in many sectors right now are laying off. So how do we have, like full employment with record low unemployment when people are laying off? What you're seeing in the news and what's really going on are two different things. So this population control effect is what's leading to this, imbalance or inaccuracy in the numbers. If you were to see, if we add the seasonal adjustment into the jobs picture that they added, that 800,000 jobs, almost 1 million jobs, it's driving unemployment lower. If you take that seasonally adjusted number out, unemployment's actually going up. It's up 3.9%, not down to 3.4%. So again, what you're seeing in the news and what's actually going on are two different stories. And this is what Barry's really trying to point out here is there's real empirical data behind this. A lot of people don't know about these seasonally adjusted numbers and what it's doing to skew the numbers. So the big jump, duration of unemployment less than 5 weeks, up 343,000. This is the stuff that's going on that's creating these imbalance in the numbers and painting an unclear picture on what the jobs market really is doing. So if you guys want to see what's really going in jobs, check this out. So most of the jobs that were lost during the pandemic, right? So you can see this obvious huge spike lower. Who lost their jobs during this time period? Mainly leisure and hospitality. The service industry is what got hammered. Those are the jobs that were lost during COVID. That was the bulk of it. Well, here we are today. See an issue with this? How do we have real job growth when we're just getting back to where we were pre-COVID. So what's really going on in the employment sector? Are we really at full employment? Were new jobs actually created over the last several years, or did we just replace the jobs that got destroyed during COVID? A lot of bars, restaurants, service industries in general, again, leisure and hospitality. Do you know how many businesses went under during that time? It took time for those people to come back and get back into the job market. And again, what was the rush? Everybody's got to remember, when I talk about the stimulus that the Fed was doing, they increased unemployment during this period of time. You could sit home and make more money collecting unemployment than you would actually working your job. And they were handing out the stimulus checks on top of it. So again, there was no rush to get back to work when you're sitting at home collecting a paycheck that's greater than what you were making. So, the real story in jobs is that we're just getting back to the levels that we were pre-pandemic. We didn't create new jobs. We don't have a booming economy. We're just getting back to where we were. So that's the real story in jobs. Takeaway from that is there's not more jobs than there were. We're just getting back to pre-COVID levels. So how do we have this booming, thriving economy that would justify further rate hikes? So then, there's a couple telling tales of the fact that a recession's coming. If you guys have again been paying attention to the news, there's lots of talk about recession, the yield curve inversion, all kinds of stuff like that. Well, here's the tail of the tape. Again, more empirical data to suggest what's really going on with the consumer. Here's credit card debt and savings. Credit card debt, pre-COVID 2018 was climbing as we were going into the COVID recession. COVID happened. Look at savings. Savings were just chugging along, and then COVID happened. Look what happened. Savings rates went through the roof. How'd that happen? Stimulus checks, right? The trillions of dollars that were getting handed out to the consumer, some households were collecting checks greater than $10,000. And again, you could sit home collecting unemployment. They bumped up unemployment significantly for those who were affected. So you got people sitting home, can't go out and spend any money, right? We were all on lockdown. So what happens? Savings rates increases and spikes through the roof. One of the fastest increases probably in history there. And consumer debt drops. Why? You got all this money. What do? You pay off your credit cards, right? It's a no-brainer. Can't go out and spend any money. We're all on lockdown. So start paying off the monthly debt, the household debt. And that's exactly what happened. So the stimulus checks go out, high unemployment earnings are being paid out, and everybody starts paying down their debt. And obviously the savings goes down with that, right? There's a direct correlation between debt and savings. So you could see this is what the consumer did. They took that money and paid off their debt. And then there was a couple more stimulus checks that the government kept throwing out, even after, before we were, officially out of the pandemic. And you could see credit card debt remained low. But as soon as we sent out that last round of stimulus checks, credit card debt started increasing and savings rates started decreasing significantly to some of the worst levels that we've seen. So now here we are. I'll give you real time here. This is through January. Credit card balances, as of yesterday's news, just eclipsed $1 trillion. So we did it, people. We got to $1 trillion in credit card debt. That's what's fueling this economy. Not strong employment, credit card debt. That's at record high interest rates. Average credit card interest rate right now is north of 20% for the first time in history. And again, we could thank the Federal Reserve for that. Why? Because that's the rate that they're hiking. They're hiking the Fed's fund rate, which controls home equity loans, lines of credit, credit cards, personal loans, student loans, car loans, recreational loans, boat loans, any kind of loan that's not a mortgage. That's what the Fed is increasing right now. So they're making this debt. We're at record credit card balances in history. We've never had $1 trillion in credit card debt out there. So again, like everybody's on here, please understand, this is what's going on. Maybe in your life and definitely in people you know's lives right now, the consumer is swimming in debt and they are no longer swimming in savings. Savings rates are down to some of the lowest levels we've seen in history. So record credit card balances, record low personal savings rate is literally the formula for a pending recession. On top of that, again, some more real-time data, fresh, hot off the press as of yesterday, people haven't had to make student loan payments for almost 3 years. They were all deferred. Guess what's coming due at the end of this year? Chris, when is it? Like September, or I believe it.
Announced it yesterday.
Yeah, September, June, July, August, roughly 90 plus days from now, student loan debt goes back into repayment. So you got to
44 million people.
How many?
44 million.
44 million people in student loan debt are going to have to start making those payments again. And here's the picture that we got going on. Consumer debt's at an all-time high and nobody has any money in the bank. How do you think that's going to work out? So this is, again, a recipe for disaster. This is why a recession's coming. So what do we do with this information? What's the takeaway for everybody on here today? What's the correlation between mortgage rates and recessions? Again, this is to educate everybody as to what actually happens. If anybody wants to guess, mortgage rates go down during recession. So if you look at these shaded areas here, this is the recession periods throughout history. Okay, so it's back in the 80s, the 90s, early 2000s, the housing crisis of 2008, 2010, which we'll talk about, and then COVID is this little skinny line here. Mortgage rates dropped from 3.75 to 2.75 during the COVID recession. They dropped from 6 to 4.875 during the housing crisis. They dropped from 7.375 to 6.75 during the early, 2001, 2002 recession. 91, 11% to 8.75. And if you go back to our parents and grandparents, mortgage rates were at 18% back in the 80s. So anybody who wants to say that mortgage rates are high in the sixes, just go back a couple generations and ask and tell them about 6% interest rates, and they'll laugh at you. They were literally 3 times that. And then, going back one further, in 1980, rates went from 16 to 11.75. What's the takeaway from this slide? There's a direct correlation to mortgage rates and recessions. Every single recession, mortgage rates go down. So just to recap, we know inflation's coming down. 43% of that core CPI number is rents, and we know rents paid are down from 18% year over year to 3% year over year. So if we know inflation's coming down, we know that's going to drive interest rates lower. That's one factor that's driving interest rates lower this summer. What else? A pending recession, consumer swimming in debt, student loan payments coming due, and having no money in the bank. So there's 2 reasons why interest rates are coming down. And we're going to tie this all up in a bow for you at the end of this presentation on how this impacts things and what to expect. Something else just noteworthy to point out. This is a general rule. Mortgage rates aren't typically posted anywhere. You got to kind of jump around and go on certain websites to find this information. There's a direct correlation, just like there's a direct correlation with inflation and mortgage rates. There's a direct correlation between 30-year mortgage rates and the 10-year treasury. So if any of you are on your phones or on a device, you go, CNBC 10-year treasury, and you can look it up. The 10-year treasury is considered a bellwether for interest rates. It doesn't tell us what rates are, but it tells us which way the wind's blowing. So if the 10-year treasury is moving higher, mortgage rates are moving higher. If the 10-year treasury is moving lower, mortgage rates are moving lower. And this is a 35-year chart that proves that. If you can literally, a 2-year-old can figure this out, right? Like as 10-year treasuries go down, mortgage rates are following. As they go up, they go down, they go up and down. The normal spread between the 10s and 30s is between 1.75% to 2%. So this is an abnormal time, it's an anomaly market. But in general, if you ever want to know where mortgage rates are, with the exception of today, and I'll get to that, there's generally a 2% spread. So you can just look up the 10-year treasury. If you look it up today, it's at 3.6 or somewhere in that range. So mortgage rates should be at 5.6. But sometimes these spreads between 10s and 30s, it gets a little further apart. They expand and they contract. So sometimes it's a little less than 2%. Sometimes it's a little more than 2%. Right now, we see a huge spread. There's about a 3% gap between the 10-year treasury and mortgage rates. So for example, again, right now, the 10-year treasury is at 3.6. If there's a 3% spread, as you can guess, you don't need to be a mathematician for this one, 3.6 plus 3 equals 6.6. So if anybody out there wants to know where the average 30-year fixed rate today is, roughly 6.6%. Why is this important? This spread is going to tighten eventually. It's not always going to remain 3%. It's going to narrow. It's going to go back to its normal spread of 1.75% to 2%. So what does this mean? mortgage rates in theory today could drop a full point if this spread compresses for no other reason. Forget inflation, forget a recession. Mortgage rates in general should be historically 1 full point lower than they are today. So this will narrow at some point. So there's a third reason why we think we're going to see a precipitous drop in mortgage rate going into the summer months, and that'll continue on through the end of the year. So don't be surprised if you see a breakout in rates and you hear rates are in the mid sixes, and then you blink and next thing you know, they're in the mid fives. There's a, again, with inflation coming down, with a recession pending, and this spread widened at the moment, there's 3 reasons why we would see a rather sharp decline in mortgage rates coming in the next 60, 90 days or so as we go into the summer months. So the real reason we're here, talk about housing, right? How does this affect us, right? We lend money, real estate professionals are selling homes. What's going on? So here's some more data. But before I jump into the housing market, any questions around some of the data that was just shared regarding the economic outlook, regarding jobs, regarding consumer spending, and the relationship between recessions and mortgage rates?
No questions.
All right. Well, I guess it's just mic drop data. Everyone's minds are just blown right now with what's going on with this stuff. But this is the real story of what's going on in our country right now. So let's get into the housing market. A lot of people think that we're potentially in a housing bubble, right? After the recent run up in home prices during COVID, I mean, we saw massive gains, right? 20% year over year, almost 2 years in a row. Home prices up roughly 40% in a 3-year period. How much higher could it possibly go? And for those who've been in the industry long enough or, heard about it, 2008, home prices went down, right? So, are we in a housing bubble? Well, a couple things to consider. We just talked about a recession. There's this perception out there that during a recession, home prices potentially go lower. That home prices are going to be weak or potentially drop. Well, here's all recessions throughout history going back to the 60s in these shaded areas here. And here's home prices over that period of time. You do not see home prices going down at all during any of these recessions. This is real information. So if you think home prices get soft in recessions and you're telling your clients to be concerned about their home price dropping during recessions, there's only one time that ever happened, and that was during the 2008 housing bubble. And I'll explain why that was a bubble. We're going to get some really good data around that. But that's the only time in history. Outside that, I mean, look, keep in mind, COVID was a recession, right? 10 million people lost their jobs during that time. Home prices skyrocketed. So, I mean, like just a recent comp for you in terms of home prices stay strong through recessions. That is a fact. 2008 being the only exception. And again, there's a reason for it, which I will enlighten you. All right, so we call, Bill Barry calls this "don't bet against the champ." Housing is one of the best investments, if not the best investment of all time. And this blew my mind when I saw this chart, and it's probably going to do the same for you. So we got 81 years of housing data from 1942. 73 years home prices are up year over year. 7 years, only 7 of those 81 did home prices drop year over year. And I want to point out, 2 of those years, 1990 and 1991, home prices are down 1% to just over 1%, just over 0% year over year, like barely. So 2 of the 7 years that home prices were down, they were barely down. Okay. And then 2007 through 2011, this is the only time in history, really, that home prices ever dropped. So this mindset that a lot of people have, and maybe some PTSD around 2008 time period, that's all it is. It's PTSD. It's not the truth. Home prices are up year over year, almost always. So, check out some of these stats. People think that because prices have gone up in 2020 and 2021 by large amounts, there must be a drop. We've had periods like this before, 1943 through 1947. Check it out on this chart. We had double-digit year-over-year growth in home prices for 5 years straight. Home prices up 118%. Okay, we're only up 35% in the last 3 years. So, if you don't think home prices can go higher, It's already happened, 118%. And after that, home prices went up for 43 more years without a drop. Like, this stuff blew me away. I had no idea about this information. 1974 to 1979, home prices up 93%. So it's happened not once, but twice in history, right here. Double-digit growth almost year over year for several years. And after that, home prices went up for 10 more years before only going down by 1% in 1990. Then another 14 consecutive positive years. Everyone focuses on 2007 through 2011. Inventory in 2007 was at 4 million. Inventory, and this is a little dated because this is, the data is not out yet. This needs to be updated, but there was 980K as of a couple months ago. So roughly 1 million homes listed for sale versus 4 million. Much different lending standards than today as well. Back in 2007, you could just, hey, you have a job? How much you make? 20,000. Do me a favor, get a marker. I want you to black out your income on your W-2. Just send me the W-2 and I'll get you a mortgage. That was what was going on during that time. Horrible lending standards. I'd say no lending standards. So that combined with a couple of other factors. So, this is to set the record straight. Again, the purpose of this call is that there's a lot of misinformation out there on the news, on the internet. This is real data. It's undisputable. So get your facts straight when you're talking to your clients. And again, we'll tie this up at the end and talk about where the opportunities are with this information. So getting into, let's talk about the elephant in the room, 2007 through 2011. Why did we have 5 years straight of home prices declining? Yeah, we had some crappy lending standards, but what was the real story behind it? So there's something called housing formations and housing completions. Housing completions are in yellow, housing formations in blue. What is a housing formation? Basically, the average age at which first home buyers buy homes. That age is roughly 33 years old. So average housing formation occurs at 33 years of age on average. Okay. We had a lot less housing formations going into 2006, 7, 8, 9, 10 for many years. What's happening, right? Why did that happen? And meanwhile, we're building homes. Okay, more housing completions, right? Like more homes being formed than ever in history. I mean, even to this day, if you look at 2022, 2023, we're still less than 1.5 million new homes being built. We were pushing almost 2 million homes back in 2006, 2007. How'd this happen? What was the real story behind housing formations dropping off? So we go back in history. We're going to get in a time machine. We're going to go back 33 years from 2006. Anybody know? That takes us back to the early 70s. Anybody know what happened in the early 70s that maybe would have had an impact on U.S. births in the country?
Vietnam War.
No, sir. Yeah, this wasn't people getting killed. This was
Disco.
well, arguably, not disco. Sorry,
Birth
sir.
control and abortion.
Look at you. Winner, winner, chicken dinner. That is correct. Birth control and abortion. So of course, this makes perfect sense now, right? So this is like one of those things, I don't know if anybody ever saw Back to the Future, Biff goes back and buys the book with all the sports bets and goes and makes millions of dollars, billions of dollars betting on all the games. If we knew this, if you think builders knew this going into the early 2000s, you would think they would have built a lot less homes, right? To anticipate less people living in them. We go back 33 years, and this is an absolute fact. Population growth dropped off by millions, year over year for several years. Look, boom, 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 it stayed low. Does that not correspond with this chart? So it's almost like, man, if we had thought about the early 70s and the impact it had on US births, we probably wouldn't have built so many homes and we wouldn't have had this big crash. So the housing bubble had nothing to do with anything other than arguably demographics. Like there's just less 33-year-olds on the planet. We built too many homes, not enough people. It took several years for that to obviously right its course before home prices started to go back on the increase, right? We got housing completions starting to lead housing formations, right? So now here we are today, we're not building enough homes and we got all these people, right? So let's just look at where we're at today. So the number of people turning 33 years old in 2023. So what I've been telling my clients for a couple of years now, the amount of people turning 33 years old for the last couple of years and the next couple of years is as high as the baby boomer population. So think about that. There's a ton of 33-year-olds out there right now. Most people we're talking to are born in the late 80s, early 90s. 66 million, right? So look at this, from the 70s and on, population growth has expanded. And look at what it's going to continue to do. Let's look into the future. Are we going to have another shortage of housing formations in the future? No. It doesn't look like it's ever going to end, right? We got a little bit of a drop off here, followed by another increase going into the early 2000s. So no shortage of people, but we got a shortage in housing. Again, 4 million homes listed for sale back in 2007, 980,000 in the beginning of this year. But here's the real story. This is the existing homes inventory. 402,000 of them are already under contract. The actual inventory is only about 500,000. If there's any realtors on this call, you know what I'm talking about. Any loan officers, you know what we're talking about too. We got a ton of pre-approved buyers. We're submitting pre-approval letters like it's our actual job, which it is, but I mean, like, we're doing that nonstop, sending out 20, 30 pre-approval letters a day for some clients and not getting the bid. There's only roughly 500,000 homes out there for sale. So that's a big challenge. We know there's plenty of people, there's not enough inventory. So, this tells the real tale of the tape here. Again, typically, we're upwards in the $1.4 million range in terms of active existing home sales. And now we're sitting down here in February at roughly 500,000. So if anyone thinks that there is a shortage in housing, you're right. If anyone thinks that there's a housing bubble, you're incorrect. And I'm just going to go back to this chart. This tells the tale of the tape right here. There's plenty of people turning 33 years old. First-time home buyers are driving the market. And again, here's the disparity. Tons of people turning 33 years old, not enough homes. So what does that mean for everything that we just learned today? I want to just wrap this up in a bow for everybody, and then we'll get into a Q&A. We know interest rates are going lower for 3 reasons. Inflation's coming down. You're going to see that as we go into the summer months, because core CPI is going to drop like a rock because rents are down to 3% year over year. Now keep in mind, rent's not cheaper. It's just not as expensive. It's just not as expensive as it was a year ago. It's not up 18%, it's only up 3%. So that's going to drive the core CPI number down. As inflation goes down, mortgage rates are going down. The real employment, the real economic outlook, we're just back to full employment. We're back to the employment we saw pre-COVID. We didn't create any new jobs. And if anything, there's layoffs going on. And then you got a consumer that's got $1 trillion in consumer debt out there, no money in the bank, and student loan debt that's got to be repaid in September. This is just a recipe for disaster. So what is lower interest rates? And then to tie this all up, we know there's more people than homes. There's more people than people containers, just put it in economic terms. So what does this mean for the future? What does the outlook look like going into the summer months and beyond? Lower interest rates are just going to fan the flames in an inventory starved market. If you think it's competitive out there today, wait until you see what happens in the next 3 to 6 months. It is going to get crazy. And people paying over ask is not crazy. We saw that home prices have room to run for the foreseeable future. The data is the data. There's no shortage of demand, and there's a shortage of supply. So too many people chasing too few homes is inflation, right? Just like too many dollars chasing too few goods is inflation. So home prices, in my opinion, after seeing this, and this is my opinion of looking at the data, home prices have nowhere to go but up. For the foreseeable future, it looks like a seller's market. So where are the opportunities in this market? Lower rates are just going to bring more people off the sideline. There's millions and millions of 33-year-olds entering the housing market every year and for the foreseeable future. So either we need to build a ton of homes pronto, which isn't happening. There's a lot of new construction going on out there, but where are the opportunities in this market? So the way I see it, again, this is my opinion. I'll throw this stuff out there and we'll get into some thoughts around it. There's a lot of economically stressed homeowners. Do you think that during COVID, when interest rates were down in the 2s and 3s, do you think people went out and do you think the debt to income ratio of the world went lower? Do you think people went out and bought the $300,000 home, which is what they would have been able to afford in a normal market? No, they went out and bought a $500,000 home. For every 1% in interest rate, that's roughly $30,000 to $50,000 in purchase power. So think about it. Rates were down a full 2%, arguably 3% compared to what normal rates would be. Normal rates would be in the 4 to 6% range. We've been in this elevated or this de-elevated level of interest rates for over a decade because of what the Fed's been doing, and people bought more than they could chew. Inflation wasn't an issue when they bought the $500,000 home. Well, guess what? It's an issue today. Consumer debt's an issue today. Student loans are an issue in a couple months, and savings is an issue. So your opportunity, if I'm a real estate agent, and this is what we're doing with our clients as originators, we're reaching out to our clients and having, kind of a coming to Jesus moment, a reconciliation of how are you handling the economic landscape right now? And we're seeing it. Any originator that works with us, we see it. The consumer debt's there. We're talking to people anywhere from $20,000 to $140,000, $150,000 in credit card debt, if you can believe it. It's out of control. And the home equity loans and lines of credit that everybody went out and got because they didn't want to let go of the record low interest rate. Well, guess what? We talked to somebody right now who their line of credit's at 13% because the Fed's hiked the Fed's fund rate so high. When they took out that line of credit, the payment was $300. And now it's almost $800 a month from what the Fed's doing. So you got economically strained homeowners where it may be a good conversation to say, hey, maybe it's a good time to list and sell the home now. You're going to make money. Like as a first-time home buyer, if I were to list my home, walk away, pay off all my debt, maintain my credit, and have some cash in the bank, maybe I'm going back and live with mom and dad, maybe I'm finding a small apartment, maybe I'm downsizing, because there is a big question of where do I go? But walk away with some money and your integrity intact, right? Your financial integrity intact, take a knee, reset, and look for another opportunity to re-enter the housing market. So that's something that we're in action about. I believe any real estate professional should be out there talking to past clients that they got into homes in the last several years and ask how it's going. You may be able to motivate some people that it's a good time for them to sell. Another one is the elderly. They haven't dealt with inflation only one time, and we haven't dealt with inflation in our lives. If you're, I'm in my 40s as an example. I was being born when inflation was an issue for my parents and grandparents. Well, a lot of retirees are dealing with the first inflation the first time in 40 years. Those pension and Social Security checks they're not completing the shopping list anymore. The dollars that they got coming in are not enough to buy everything they have on the shopping list every month. So, they're constrained. And, and here's the beauty of it all. Like there is no housing bubble. Everyone's sitting on a massive amount of equity. The average consumer, the average homeowner, is sitting on $185,000 in equity. The loan to value of the country is at its lowest level in history. So people have more equity now than ever in history. So that's a great thing. So maybe it's just time to take the chips off the table, reset, move back in with family, do what you got to do, but not wait, because waiting is going to cause them more economic pain. If they default on their mortgage, I'm telling you right now, this is not like the housing bubble. Banks are foreclosing on homes immediately. Why? Because they can. They know they could turn around and sell the asset. And just to kill one more myth out there, banks don't want to take your home bank. They don't. They got to pay legal fees. It's expensive to process foreclosures, and they got to pay the taxes, insurance, and maintenance costs on that home while they're not getting paid. So banks are very motivated to foreclose right now. Like within 30 days foreclose, get the house on the market because there's a housing shortage. Back in 2008, banks and court systems stalled the foreclosure process. Why? Because home values were tanking. Hold on to the asset a little longer and wait till things right the ship. And I don't know if you noticed this, but around 2012 and beyond is when all the foreclosures started getting processed. because housing formations were coming back. There was people there to buy the homes. So all that said, I'll stop there. You know, those are just some of the theories and things that I've gained from this information. And then, you know, I guess one last point is there are homeowners out there who want to move and have been waiting for interest rates to come lower. Well, they're finally going to get their wish, because as interest rates drop, they're going to be motivated now to give up that record low interest rate and grab a relatively lower interest rate and make their move because they increase their family size or they're making more money, vice versa. So a lot of information to take in an hour, so I'm trying to get it all as fast as I can. So I'll leave it there and open it up to any questions. If anybody has any questions, now would be a good time to speak up.
Steve, I have a
Otherwise-
question. I don't know
Yes.
if it's a good question, but
All
what
good
if
questions.
the Fed doesn't raise the debt ceiling?
Yeah, so the debt ceiling, it's a bit of a joke. The debt ceiling's been raised over 100 times. I don't have the exact numbers in front of me, so I might butcher this, but over the last 60, 70 years, it's been raised over 100 times, like 119 times. It doesn't make sense that there would ever be a cap on the debt ceiling, in my opinion, for one simple fact: there's more people living on the planet. You know, the government, you know, think about all the government services that are out there. You know, there's more people on the planet, there's more people that need to be serviced. So to me, it only makes sense that we're going to spend more money naturally because there's more people on the planet. So the real motivation behind debt ceiling is for the parties to push their legislative agendas along. So there is no debate about raising the debt ceiling. There's a debate around which laws they're going to get passed through, and they're holding each other hostage, and they use the debt ceiling to do that. So, you know, so there was an article that just came out from Zillow recently on this. You know, mortgage rates are going to spike to over 8% if the U.S. defaults on its debt. I'll tell you this: if the U.S. defaults on its debt, who cares about mortgage rates? Who cares about housing? If we default on our debt, it's going to be Armageddon. The world's going to come to an end. You know, you're talking about the U.S. dollar losing reserve status. Like, I mean, it's an absolute and total. It'll be total chaos and anarchy. So the debt ceiling will get raised. It'll continue to get raised. They should think about just not putting a cap on it. We just spend money. That's what we do. And again, it's putting some upward pressure on interest rates here. But everybody's confident that they'll increase it because, again, the U.S. defaulting on the debt is not an option. And the rest of the world will have an negative impact if that happens as well. It's not just the U.S. This affects, you know, it's a global economy at this point. I'll recap with this. You know, if you're here on this today, if you listen to this in the future at some point, there are opportunities in this data on where to get your business from. Go find motivated sellers. They're out there. We're talking to them. If they can't consolidate their debt and get their financial house in order, they are going to have to sell because they're going to stand to lose equity. It's not like 2007, 8, and that time period of time. People had no equity at that point in time. There was 100% financing being done. Everyone's gaining from appreciation, so they're motivated to sell or consolidate. So that's where the opportunities are in the market as we go into the summer months and beyond. And the argument would be to shake people off the sideline and get their hand in and try to buy a home today. Like, we're going to make it worse as a result of this, just for the record, because there's no motivation for a first-time home buyer to wait to buy a home because they're just going to pay more for the home in the future. Waiting for interest rates to come down is the worst possible move. You're going to miss out on appreciation, and you're going to be competing with 10x the amount of people, because as rates go lower, purchase power increases 30 to 50K. So that person out there that can't buy a $300,000 house today is going to be able to when rates drop a full point. That person that can't buy that 350 house and is stuck at 300K and can't find what they like is going to be able to buy that $350,000 house when rates drop a full point. So the motivation is do something now and talk to past clients about how they're weathering the current economic landscape. So any other questions? Otherwise, thank you for your time, and hopefully this was informative for everyone. And now you know what's really going on in our world.